Welcome to Investment Portfolios. And this week we're going to talk a little bit about some investing styles. And in your PowerPoint for this week's chapter reading, they talk about several different investing styles, including a growth style. In the growth style, you're looking for future earnings that you're expecting future earnings that you believe are going to justify a high PE ratio. Or you've got a returns-based style analysis, and you are characterizing a portfolio based on its return. And then there's also a holdings-based style, where you're going to categorize securities by the certain characteristics or valuation or forecasted growth. I want to talk a few minutes about this value investing style. I think this is worth discussing and learning something about this value style. And with value investing, we're more concerned about the stock's price. We're going on price. We're looking for prices that are low compared to their earnings or compared to the book values. And so what the thought process here is that earnings are going to show us some opportunities where the prices are temporarily depressed. And we don't want to overpay for glamour stocks. We want to get low prices. And there are some risks with that because the stocks are cheap for a reason. So we have to do a lot of research to understand why the stocks are cheap and why we think that it's a value. So when we look at value investing, there's several basic concepts that we have to realize with that. The first one is that we're going to buy on sale. When we are value investing, our belief is that the company is worth more than we're going to pay for it. And so, in other words, companies have an intrinsic value. So the idea is that if we know the true value of something and we can determine that the price currently is less than that true value, but at some point it's going to go up to that value. So we're saving, we're buying on sale at a discount. And we are going to also have this margin of safety. Benjamin Graham was considered the father of value investing. And his philosophy was that he only bought stocks when they were priced at 2/3 or less of their intrinsic value. So what he believed to be the true value of the firm, if the stock at any time was 2/3 of that price or less, that's when he would buy. And what that does is that gives him a margin of safety so that if it goes up to the true intrinsic value, he's made that 1/3 on the price, but there's that margin so that even if he's a little off on what he considers the true value, if it goes up some, you still got a margin of error here where he can be off on the true intrinsic value and still make money on the stock. So when you buy a stock at a bargain price, that's going to give you a better chance of earning some profit later when you sell it. And it makes you less likely to lose money if the stock doesn't end up performing as you believe it will. So not only is it on sale, you have to have that margin of safety where you're definitely going to make a profit even if you're off on the true intrinsic value. Value investors believe that the markets are not efficient. We don't subscribe to the efficient market hypothesis because that says that stock prices already take into account all the information available about that firm. And so in order for us to believe that stocks go on sale, we believe they're underpriced, which means that all the information about the stock isn't in the price, or else it would be higher, it would be at the intrinsic value. So we believe that there's some information that the stock price is currently overlooked. And so we can see that a stock is being underpriced, and we can take advantage of that. So it might be that the stock is underpriced because the economy is just performing poorly and investors are panicking. Or we could see that a stock is overpriced because people have gotten too excited about a certain new technology, like with the dot-com bubble, stocks were overpriced. So we're going to investigate stock prices to see if they're on sale, what kind of margin of error is there, and we're going to believe that there's a reason, an explainable reason why the stock is on sale, and there's some extra value that we can gain by purchasing now. And the value investor understands that they are not going to be following the herd. They're not going to be following the crowd. Because of the fact that we don't accept or subscribe to the efficient market hypothesis, that means when everyone else is buying, we may be selling, or vice versa, or just holding off. So value investors don't necessarily buy the most popular stocks of the day. Remember, we're buying stocks that are on sale. So these are stocks that maybe others have lost confidence in already, but we see that there's some additional intrinsic value that could be gained. So value investors actually believe that companies that offer customers valuable products and services can recover from setbacks. Even when they've been abandoned by the popular movement, we see that there's still value in certain stocks and will go against the grain and make those investments. Now, to find these sales, though, requires a lot of diligence and patience, because you can't use some value investing formula to necessarily pick the right stocks that fit a certain criteria. You have to do research. You have to have the patience and diligence to wait out for your investment to materialize into that intrinsic value that you see there. So value investing is somewhat of an art form. It takes a lot of research, it takes patience and diligence, and it takes the guts to go against the herd and to find bargains. And bargains that have that necessary margin of safety in case you don't quite have it predicted well. And so it's a different style of investing than like some of the others, like we talked about growth, where you're going to actually pay a premium for greater growth prospects. So this is an active form of investing. In this unit, we're also going to talk some about EFTs and index funds, which are a more passive way of investing, and where your investments are just going to match the market. So you will have lower fees involved with that. You're going to have actually lower transactions as well as lower transaction costs when you use EFTs and index funds, and it requires less research on your part. So these are some things you can look at this week. There's a lot of good information, great videos in the additional resources area, well, websites and links in the additional resources area for you this week. And there's a lot of information for you. I didn't want this video to be very long because you've also got a test this week. You've got the assignment, you've got the discussion, you've got the videos in the additional resources area, and the test. So I want to make sure you have plenty of time to get to that stuff. I just wanted to show you some perspectives on value investing. We can discuss this further in class discussion if you would like, and talk more about this topic or others. Anytime you have a question, you can discuss it in the class discussion forum, or you can send me emails as well. I'm going to wish you a great week 3.